What if I told you that $100,000 invested at the absolute worst moment in the last 20 years, right before the 2008 crash, would still be worth nearly $500,000 today? And what if the only reason most people miss out on returns like that is because they're trying too hard to be smart? My name is Mark, and 3 years ago I made a mistake that cost me over $40,000 in missed gains. I had 43 different stocks because I thought that's what smart investors did. I was constantly researching, constantly tweaking, constantly stressed. Meanwhile, my buddy Jake dumped everything into one boring ETF called VOO and never looked at it. 3 years later, his returns destroyed mine, not by a little, by a lot. That moment changed everything for me. I realized I'd been sold a lie about investing, that it has to be complicated to work. But here's the truth nobody tells you. The simple approach doesn't just work, it beats almost everything else, including the professionals who do this for a living. Today, I'm going to show you exactly why I moved most of my portfolio into VOO, what happens when you invest at the worst possible time, and why going all in on the S&P 500 might be the smartest move you'll ever make. By the end of this video, you're going to understand something that took me years and thousands of dollars to figure out. Let's get into it. All right, let me take you back to where this whole thing started for me. It's 2022, and I'm sitting at a bar with my buddy Jake talking about investments. I'm going on and on about my portfolio, 43 different stocks, my strategies, my picks. I thought I was crushing it. When I asked Jake what he was holding, he just shrugged and said, "I don't know, man. I just put everything into VOO and forget about it." I actually laughed at him. I thought he was being lazy. In my mind, I was the sophisticated investor. He had one ETF. I had 43 stocks. I was winning, right? Wrong. Dead wrong. Fast forward to early 2025. We meet up again. This time we compared our actual 3-year returns. My complex, carefully researched portfolio, up 18% total. His boring set it and forget it VOO strategy, up 47%. I sat there doing the math in my head. On a $100,000 portfolio, that's a $30,000 difference. When I factored in all the stress, the panic selling I did during dips, and the opportunities I missed, the real cost was over $40,000. That night, I went home and just stared at my portfolio. All that research, all that complexity, all that time, and I got crushed by the simplest possible approach. Jake wasn't smarter than me. He wasn't luckier. He just did less. Way less. And that's exactly why he won. That realization hurt my ego, but it saved my financial future. Now, here's where things get really interesting. I ran a test that completely changed my perspective. After that conversation with Jake, I became obsessed with one question. What's the absolute worst that could happen if I went all in on VOO? Because that's what stops most of us, right? The fear of losing everything. The fear of bad timing. So I found the single worst moment to invest in the S&P 500 over the last 20 years. 2008, right before the financial crisis. If you had the worst luck in the world and dumped your entire $100,000 into the S&P 500 in early 2008, you would have watched it implode. That year alone, you lost 38.49%. Your $100,000 dropped to $61,510. Brutal. Gut-wrenching. Most people would have panic sold and sworn off stocks forever. But let's say you didn't panic. You just held on through the worst financial crisis since the Great Depression. By 2013, 5 years later, you'd be back in positive territory at $125,971. Not amazing, but you're breathing. Then you ride through mostly good years until 2022. Another rough patch, down about 20%. But 2023 and 2024 roared back with over 20% gains each year. Here's the number that changed everything for me. As of 2025, that $100,000 you invested at literally the worst possible moment would now be worth $461,797. You picked the worst timing imaginable. You lost 40% in year one. You lived through 2 major crashes, and you still ended up with nearly $500,000. When I saw this, all my fear about market timing just evaporated. If the worst-case scenario still gets you to nearly $500,000, what are we really afraid of? Right now, people are worried about a 10% or 20% correction. I just showed you a 40% crash, and it still worked out. That's when I realized fear of bad timing was costing me more than bad timing ever could. Let's talk about the real numbers now, because this is where it gets exciting. Since 1957, the S&P 500 has averaged about 10.33% annually with dividends reinvested. That's nearly 70 years of data covering wars, recessions, pandemics, everything. So what does that actually mean for your money? If you invest $100,000 today and never add another dollar, in 20 years you're looking at $714,000. 30 years, over $1.9 million. In 40 years, if you're young and let this ride, you're sitting on over $5.1 million from one investment. Just time and compound interest doing the work. Now factor in inflation and your real returns are around 7.5% annually, still incredible. Your purchasing power actually grows, not just your account balance. But here's the catch. This only works if you stay in the game. Those returns are averages. Some years you're up 30%, other years you're down 20%. The journey is not smooth, and that's exactly why most people fail. Here's what I couldn't understand at first. If the data is this clear, why doesn't everyone just do this? Why are there thousands of actively managed funds and people trying to beat the market? It's psychology. We're wired to believe more effort equals better results. In every other area of life, that's true. Gym, career, skills, work harder, get better results. So our brains tell us the same story about investing. More research, more trades, more complexity must equal more returns. But the stock market doesn't reward effort. It rewards time and consistency. Then there's the professional trap. We assume fund managers with teams of analysts and sophisticated algorithms can beat a simple index fund. They're experts, right? The data says otherwise. Study after study shows that 80% to 90% of professional fund managers fail to beat the S&P 500 over long periods. These are people spending 60 hours a week on this, and they still lose to VOO. If they can't do it, what chance do I have? But here's the beautiful part. VOO does all the work for me. It holds 500 of the largest U.S. companies across every sector. If a company's doing well, it automatically gets a bigger weight in the index. If a company starts failing, it gets kicked out. I don't have to pick winners or sell losers. The index does it automatically. No emotions, no second guessing, no regret. At 25, I was trying to do all of that myself, and I was terrible at it. VOO eliminates the hardest parts of investing. All right, let's address the elephant in the room. What about investing right now in 2025? Look, I'm not going to pretend everything is perfect. Valuations are elevated. We've got geopolitical tensions, tariff issues, inflation concerns, and every other week some analyst is calling for a crash. I hear all of it. Part of me still gets that uncomfortable feeling. But here's what I keep coming back to. Every single generation of investors has faced these exact fears. In 2008, people thought the financial system was collapsing. During COVID, the world literally shut down. After September 11th, terrorism fears dominated everything. And every time the people who panicked and sold locked in losses, the people who stayed invested ended up wealthy. So is this time actually different? Are we facing something the market has never survived? Honestly, number. Is there risk? Absolutely. But there's always risk. Another crash is definitely coming at some point. The question is whether I'm going to let fear of that crash keep me from building wealth over the next 20 to 30 years. Okay, let me show you exactly what I'm doing with my own money. No theory, just my actual strategy. The majority of my portfolio is in VOO, and I add to it every single month. I've set up automatic investments that pull money from my checking account on the 15th and buy VOO regardless of the price. Some months I'm buying at all-time highs. Some months I'm buying during dips. Over time it averages out. That's dollar cost averaging, and it's the only way I've found to remove emotion from the equation. Here's my thinking. If VOO is around $600 right now, and I'm comfortable investing at that price, then a 20% crash that drops it to $480 should make me more comfortable, not less. Because if I believe in the long-term fundamentals, and I do, then getting a discount is a good thing. I know it won't feel good watching my account drop. I know I'll have moments of doubt. But based on every historical precedent, the market comes back, and I'll be buying at lower prices during the drop. I'm not going to lie and say I never feel scared. When I see my portfolio down $20,000 or $30,000, it stings. There's a voice in my head that says, sell now, buy back lower. But I know that voice is wrong. Every time I've listened to it, I've lost money. So now I acknowledge it, then I ignore it. I remind myself I'm not investing for this year. I'm investing for 2045, 2050, 2060. When I zoom out that far, a bad month or bad year is just noise. The emotional side is real, and I want to be honest about it. But what I do have now is consistent growth, low stress, and a portfolio that's actually building wealth instead of just keeping me busy. So here's what I want you to take away from this. You don't need to be a genius to build wealth. You don't need insider information or complicated strategies. You just need VOO, time, and the discipline to stay invested when everything in you wants to panic. That's it. That's the whole game. Let me give you one more number that matters. VOO's expense ratio is 0.03%. That means for every $10,000 you invest, you're paying $3 per year in fees. $3. When I was younger, I had money with a financial advisor charging 1.5% annually. I thought that was normal. But on a $100,000 portfolio, that's $1,500 per year versus $30 with VOO. Over 30 years, that difference is massive. Those fees compound against you. Every dollar you pay in fees is a dollar that's not growing in your account. And here's the thing about timing. If you're sitting on cash right now, waiting for the perfect moment, stop. There is no perfect moment. The best time to start was 10 years ago. The second best time is today. Time in the market beats timing the market every single time. I wasted years waiting for dips, trying to be clever, and all I did was miss out on gains. Don't make the same mistake I did. So here's what you do. Set up a systematic investment plan, whether that's $200 a month, $1,000 a month, whatever works for your situation. Automate it so you're not making emotional decisions every time the market moves. And then just let it ride. Check it once a quarter if you want, but stop obsessing over daily movements. Zoom out. Think in decades, not days. If this approach resonates with you, hit that subscribe button because we're just getting started here at Dividend Hustle. I created this channel to cut through all the hype and garbage in the investing world and talk about real strategies that actually work. No get-rich-quick schemes. Just proven approaches for building serious wealth. Drop a comment below and tell me, are you already investing in VOO, or is this video pushing you to make the move? I read every single comment, and I want to hear from you. And if you want me to break down my full 3-fund portfolio and show you exactly how I allocate based on age and risk tolerance, let me know, and that'll be my next video. This is Mark from Dividend Hustle. Thanks for watching, and remember, simple wins. I'll see you in the next one.